Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about Bank of America, JPMorgan, Wells Fargo, and Citigroup. A number of the other larger banks are also going to be reporting earnings this week, but I like to just focus on the big four. If you find this content helpful, please consider leaving a like or subscribing. This week and this video will mark 1 year of being on YouTube. My first video was last year, April 14th, covering Bank of America into earnings. So that's why I wanted to go ahead and start with Bank of America. The reason I want to highlight the banks in general is because right now we're getting ready to look at the banking industry going straight into earnings at their highest valuation of all time. Just to showcase what this looks like, I've got the 5-year chart. We did have banks at a very high valuation going into 2020. It was the highest of all time. One of the things I very much so like about the banking industry is you can see at each individual earnings right here, they've also been paying a quarterly dividend. So Bank of America stock has had a dividend yield of anywhere between 2% to as much as 4% and a little bit higher over the past year. What I'm going to be looking at this week is primarily are we seeing a return to profitability associated with interest income, which means that they're starting to churn loans again, as well as B, are they reducing their allowance for loan losses? The reason for that is because that is the largest management estimate on the balance sheet. And because they have some subjectivity associated with that number, there's a lot of scrutiny associated with it. If we look at where that shows up on the bank statement, down here in the income statement, you can see loan loss provision. This is an item that we traditionally have not seen from our other institutions that we look at. This is a bank-specific loan loss item. So what I want to highlight here is, as you can see, that Bank of America has actually been reducing the amount that they are providing for loan losses over the past 4 quarters. However, if we look at this on an annual basis, you can see the sheer amount that they added in 2020 compared to years prior. So this was a pretty substantial increase for a estimate that goes straight to the bottom line. This is something that goes negative from the net interest income. So again, if you make some moves on this item, it can have a fundamental increase and or decrease on the final net income. What we're going to be looking at is primarily associated, though, on if we're seeing this interest income and that fee income is actually coming back and helping the bank achieve overall higher levels of profitability. The other thing that I would highlight when we make this comparison to some of the other peers is that it is going to be very important to see how the first institution, which is going to be Bank of America, is going to be JPMorgan, actually announces and showcases, are they continuing to reduce their allowance, which is what they did in Q4 of last year, because that should set a good standard for the other institutions as well. What I really want to highlight when we look at this is that banks are trading at historically high levels of valuation. So right now, I do have call options associated with JPMorgan for the end of the month at the 160 price target, but right now I already hold shares of Bank of America, and I don't intend to purchase more at these key levels. However, I think that there are some great opportunities on a pullback in the future. Traditionally, banks have not been historically large movers, so I'm not looking for a 20% return over the course of this month, and I think that it's important to note that these are some of the largest institutions in the United States. What we're really looking on is steady growth as well as that dividend income. You can see here just from a valuation analysis that Bank of America is currently trading at a pretty high price to earnings or PE ratio of 21.35. The reason I highlight this as high is because historically the targeted PE ratio for banks was right at 12. Right now we're nearing double that, so it's important to note that. And price to earnings is really what most banks are going to be priced at, not necessarily price to sales, which is what a lot of the high growth companies we've been looking at are targeting instead of PE ratios. The other piece of that, or the reason behind that, is because most not making a profit when we look at these super crazy high growth companies. So I want to compare them because we're going to be looking at JPMorgan, we're going to be looking at Wells Fargo and Citigroup, and I'll get rid of United States Bank or US Bancorp, because these other companies that we're looking at with JPM, Wells Fargo, Citigroup, these are the largest 4 institutions in the United States. It's important to note that they have grown exponentially over the past 12 months. And so the reason behind that is because we've seen a rampant increase in stock prices and stock valuations overall, but it's also important to note that as the value rotation has come back into play, the banking industry has been somewhat of a stalwart, and they know that there is a safe return on investment there, even if it's just looking at that dividend income. However, with this huge increase in stock price, you can see that this dividend yield right here, we've actually seen a large decrease in the overall price or the dividend yield compared to what we were looking at. In one of my older videos, I highlighted that people really like to buy in to Bank of America when that dividend yield is over 3%. That's more than 6 months now that we've seen that level. So because I don't anticipate that high level of pullback anymore, I don't anticipate seeing people looking at some of these banks as necessarily the highest level of dividends. However, there are 2 different items that could really play into either A, increasing the dividend, or B, increasing the value of the share prices in these stocks overall. In December, the Federal Reserve announced that these institutions had the capability to reinstitute share buybacks. The other thing that they are allowed to do is beginning this summer, they are allowed to increase their dividend yield. So if you look at some of these revenues down here and then the profitability on those revenues, the 2 kind of leaders in this space of Wells Fargo, or not Wells Fargo, definitely not them, JPMorgan and Bank of America have huge revenue amounts, as well as they've continued to post very strong profitability numbers. With that being said, if Q1 numbers come through, if that profit stays up, and the revenue is increasing, I would be surprised to hear that either A, those share buybacks have not taken place or begun to take place, and B, there may be even the chance of an increase on that dividend, which would bode well for the stock as well, again increasing that value return. So that being said, I'm going to be looking at, in particular, the share buybacks, especially JPMorgan. They've already had their share buyback program approved by their board of $30 billion. Prior to the pandemic, they were buying back $6 billion worth of shares on a quarterly basis. So what does that look like? Why is that important? Well, right now, their shares outstanding is 3 billion shares. So the overall share price of $156 a share, if they can buy back right at another $5 to $6 billion in Q1, that means that the shares outstanding number begins to be reduced, which means that the value of the stock outstanding continues to go up. The other thing that could be tied into this as well is if they increase that dividend as well, that means you're getting basically 2 catalysts for the stock. That's why I think that some of the options capabilities here are beneficial, because you can play close to this, because I don't think we're going to see a 20% return on investment over the course of the next month, but rather I do think we could see some upward momentum, at which point in time I would probably flip out of the options and continue to just ride the shares, because there's a lot of value here. So we're expecting very strong numbers from the banks in line with that reduction in the allowance for loan losses, as well as increases in interest income. What that looks like for these institutions is you can see that we're actually expecting on the higher side of earnings for Q1. The big thing is going to be looking at is what do we anticipate charge-off experience to be like over the next 12 months. So charge-off is when a bank has to rescind on their loan and say, hey, we want our money back because you can't pay. We're going to foreclose on your house, foreclose on the business, and take that back. If we anticipate that there are going to be more charge-offs this calendar year, then it's going to be important to note that, because that means that the bank will make less money on interest income and they will have to increase their non-interest expenses, which is what they do to have to utilize to go and get some of that money back. So this is what we're going to be looking at. All in all, we're expecting pretty strong numbers. Again, Q1 is normally not the the powerhouse of the year, but it's one that we're going to be watching because there's 4 or 5 different variables at play for these larger financial institutions. The reason that I've primarily been focused on JPMorgan and Bank of America is because I consider them to be the best of breed, and Citigroup is probably my third best case scenario, although they definitely have the capability to make some runs in the future. However, I just don't like Wells Fargo. They've had historically tenuous management positions, as well as I have struggled to invest in a company that's had multiple scandals that personally I just don't agree with the overall management style. That being said, they also haven't increased as much over the past 52 weeks, and they may have the capability to grow just as fast. But this is just a few of the items that I'll be looking at as all of these companies announce earnings this week, as I am looking to play the JPM, looking to hold my BAC, and I may be looking to watch Citigroup as well because they may make similar announcements to JPM and BAC concerning buybacks or dividend investments. So if you find all of this content helpful or would like to see more, please leave a like and subscribe. I appreciate you watching. And for those of you who have been around for the better part of the past year, thank you for making it. This is now the 4th time we've covered the bank earnings, and one that is pretty exciting. So thank you for what you do. If you'd like to join and interface with us a little bit more, feel free to check out the Discord in the description below. And if you have any feedback, please drop that in the comments down below as well. Thanks. Talk to you all later.